Hey guys, this is Soarance. Just a quick live recording here on a brief introduction as to how I develop algorithms. And for those of you, and I know many of you are, who are interested in developing algorithms for your trading strategies, such as futures, then this is a general good guideline as to how you should do things. Of course, this isn't going to be a comprehensive video, and you can find more information in some of the YouTube links that I like to share around. But if you want to ask questions or how you can develop your own strategies and you need more detail on that, feel free to send me a DM or message me in the algorithms trading channel in Delta Hive, and I will be happy to guide you from there. So I know a lot of people have been messaged me and or expressed interest in developing trading algorithms themselves. So before we get started, the first thing I wanted to know is that algorithms are not probably not the way that you think that they are developed. A lot of people think that you could just take a manual trading strategy and then apply some rules to it, slap it on TradingView or use AI to code it, and then that way, and then adjust some of the parameters, and then you can get an equity curve that looks smooth, and then from there you just kind of trade that. Unfortunately, that's not exactly how it works, and the development process is a little bit more complicated than that. So that's why I'm here to show you a little bit on how I do it personally after all the time I've spent researching and learning the process myself. Okay, so let's get started. Likely the strategy that you're going to develop is probably not going to be one you have in mind. So as I said before, if you just take an already existing strategy that someone trades manually or you yourself trades manually and then code it into a strategy, it's likely not going to be as effective as you think. And what you end up with as a final product is probably going to be something that you never really expected as being a strategy, something that you kind of cooked out of the blue, so to say. So yes, the other thing to note is to tamper your expectations. I made an entire document on how to spot bad algorithms. So if you want to take a look at that, it details as to what you like what if you see any strategies or algorithms online that someone is selling to you. There are some red flags to look out for. So it serves as a dual purpose. You can use it to identify bad algorithms out there on the internet, but at the same time, you can also use it to evaluate your own strategies. So things like, for example, if the profit factor is like way too high, or if your curve looks way too smooth or something. The document details a little bit on that. So let me know if you want access to that. It's actually in the pinned comment in my callouts channel, the Soarance callout channel. So if you look there, you'll be able to find that document as well. I'm also working on a written guide. So if this is not exactly the format you want to see, then the written guide will be a good introduction to start as well. So you can take a look at that. But a lot of information between here and there is going to be repeated. But yeah, nonetheless, glad to have you guys watch this. And again, if you have questions, just feel free to message me on Discord. Okay, so I'm going to divide this into a couple steps that you're going to have to follow. And of course, there are a couple of different ways to develop your strategies. This is the way that I use to develop simple rule-based strategies. So I would say there's two types of algorithms you can develop, and one is simple rule-based strategies. So this could be something like, for example, a 921 EMA cross. That would be a simple rule-based strategy, as opposed to a mathematical model, which, for example, would be something like a hidden Markov chain or something like that. So it depends on what strategy you do, but this is just going to be for simple rule-based ones because personally, in my opinion, those often are easier to develop, and for beginners, it's generally you're gonna have a better time making strategies for those. The ones that I run in the Discord are simple rule-based strategies, so they are good, especially if you know how to develop them. Okay, so the first concept I want to go through is this concept called overfitting. So I'm using one second. How do I change this so that I can sketch? It should be like this button, but I'm not sure. Is this it? Okay. Yeah, so the first thing is this concept called overfitting. And forgive my handwriting because I am using a mouse to draw this. Okay, so this is incredibly important and why most strategies online don't work. The general concept of overfitting is that you fit too many indicators, too many factors that fit too well to your backtesting data. And it's precisely because you're looking at it in hindsight, the backtesting data, that it is overfit. So then you oftentimes have a strategy that just doesn't perform well live. And it looks good on the backtesting data, however. But when you run live, it fails. So this is generally what it looks like. So if we have a P&L curve, for example, let's say this is time, and then here you have the P&L. So an overfitting one would look like this. Like it would look really good. And let's say this is the time that you're currently developing your strategies. So after it looks good, and you're like, oh my God, this is good to run. And then when you actually run it live, what actually happens is that it either chops or it kind of just fails like this, or it could even go down. Now, this is only one possibility. It's possible that it could also go up and it looks good and then it kind of goes down, or it can even go up for a longer period of time. It can be luck. This can be luck. Okay. Oh, that looks bad. Anyway, it can be luck, but in general, what you'll see is that it starts chopping downwards kind of slowly, or it just goes straight down. So that's generally what happens when you overfit a strategy. You fit too well on your backtesting data that it doesn't actually have a real edge. So that's the basic concept of overfitting. And I'm going to create a new diagram for us to start. Okay, so how do I develop my strategies to avoid overfitting? There's going to be a lot of testing, and you're also going to be forward testing a lot. So this actually will take a lot of time. In general, it'll probably take somewhere around 3 months to develop a strategy, and that is generally pretty good. In my opinion, it'll need longer than 3 months to actually do a forward test. The amount of time it takes for you to create a strategy from scratch up until the forward testing phase could be anywhere between just like a day to like a couple months even. So it sort of depends on the strategy itself. All right, so like I said, I'm dividing this into a couple of steps. So step one is going to be screening. Okay, so screening means that there's not much to this part, and this is probably relatively easy compared to the rest of it. But screening just means that you're going around testing a bunch of strategies. Now, these strategies have to be simple. Okay, so it could be something like I mentioned before, a 921 EMA cross. It could be something like, oh, we're filling the gap in the morning if we see a direction compared to the previous day's close, or something like that. It could be like an RSI overbought, overfit, mean reversion strategy. So those are the things you're trying to screen. The key thing here is to keep it simple. Okay, you have to keep this part simple, the strategy simple. Like for example, if you have a really complex strategy that's like, oh, we're doing the strat by Rob Smith, and it happens when the SMI is currently curling in a certain direction, and the previous ATR has to be a certain amount and stuff like that. If you have a bunch of stacked conditions already into your strategy, then that's generally not what you want to screen. You want to screen for things that are relatively on the simple side. Okay. This usually you have a failure rate. Okay, we'll call it FR, I guess. A failure rate of, if I had to give an estimation, maybe about 90%. So that means that 90% of the strategy you screen for is going to fail. Okay, which is fine. If you have a strategy that fails, don't get too hung up on it. Don't get attached to each of the strategies that you screen because most of them are going to fail. What you're generally looking for is like, let's say you have a graph again. You're probably looking for something that goes up overall and is somewhat kind of choppy like this. If you have something that's too smooth like this, I would be a little bit suspicious on it. This is likely due to either future leaking, which means that your code is peeking into the future for future data, which is incredibly easy to commit, by the way. Or it's something like repainting or something along those lines. Or it could be like, for example, you didn't have your bar magnifier turned on training view, which means it wasn't using the proper tick data that it needs to in order to calculate proper TP and SL. So if you see something too smooth, that's probably not working. There's probably something wrong with it. Okay. You're looking for something maybe around a profit factor of about, maybe it could be above, let's just be generous, 1.05. Okay. Ideally, maybe something above 1.1, but if I see something above 0.05 and I see the curve is consistently going up without significant drawdown, this is probably something that passes the screening. Now, if you have also something like this, let's say you have a really high profit factor, and let's say I'm going to draw a second graph here. Let's say you have a curve that looks like this. Okay, like it goes up and then it goes down to the negative, up, down, negative, like this, and then it just happens to end here as you're doing this back test, then this is not good. Even if you have a profit factor of like 1.2 or something even higher, this is not good because likely you're just capturing at a specific coincidental time in which the strategy was profitable since you tested the strategy. Okay. So something like this, I wouldn't bother. Something like, if it went negative and then up, I would kind of consider as well because it could be regime specific. Let's say this one was like 2020 onwards or something. This one could be worth considering if you're willing to admit that your strategy might not last as long as you want it to. That being said, you also need to do something called a Monte Carlo permutation test. And I personally would just do this on the entire data. So let's say you have 16 years worth of data, which is, I believe, on default for TradingView if you're using 5-minute time frame. Of course, if you use higher time frame, I think you have more data. If you use less, like 1 minute, it only gives you 3 years of data, which is not very good. Personally, oh yeah, I guess that brings me to another point. Although I said testing on TradingView, you probably shouldn't be doing this on TradingView anyway. I recommend downloading this data, historical data from a website such as Data Bento. They give you free credits when you make an account, so you can just buy, for example, historical data for NQ, ES, or GC or something like that, which is relatively cheap and you wouldn't really have to pay. I personally avoid some of the free data because I have concerns with their data quality, but get data from somewhere like Data Bento, which is my recommendation, put it into Python, okay, and then code your strategies there. Don't just do this on TradingView. It's just not going to work. I should have said that in the beginning. Sorry, I'm saying that now. But test it on your entire historical data. So let's say we have 16. Oh, let's say we have 16 years of historical data. We're going to run our Monte Carlo permutation test on that. Okay, so, okay. Monte Carlo permutation test. I'm very bad at writing with my mouse, so apologies for that. There's a couple of different types of Monte Carlo tests, such as the drawdown test and like that. And Monte Carlo is generally really good at doing a lot of simulations. Basically, what Monte Carlo basically is that you simulate however many times on a specific scenario that could happen after you shuffle trade data or you shuffle any data. Basically, it's called Monte Carlo. And then you want to derive a certain pattern or a certain result from there, basically. The permutation test specifically is when we're shuffling market data. And then as a result, we want to see how our strategy performs when it's basically trading on noise. And then we want to compare our strategy to that to see how well it compares compared to noise, to see if our strategy was actually due to luck or if it means it actually has a real edge. Of course, just one permutation test is not going to tell us much, but it gives us a bit more confidence. Like if it passes the permutation test, I'd be comfortable at proceeding past the screening step. So let's say you have the permutation test. It would look something like this. First of all, you want to have your N, which is the number of simulations, set to about 1,000. You could probably go for less if you have like a weaker computer that can't really do much, because it might take too long to run. But in general, 1,000 is a good compromise. It's not going to take too long to run, and it's going to give us a good amount of sampling data. Later on, we'll do the Monte Carlo permutation test again, but we're going to use a smaller sampling size or a smaller number of simulations, because then it's just going to honestly take too long for our computers. Okay, so for this part, in the screening step, we're going to set it to 1,000. And by the way, in the coding part, you can actually just tell Claude to do everything for you. There's not really much of a use to learning coding anymore. Because Claude and Codex, for example, can just do it for you. So I recommend Codex or Claude. I personally think Claude is the best. You can use Opus for this, but if you want it to help you in some decision making, the Fable plan is currently out, and you can use that. If you're okay with spending like $100 a month or something on this, then I recommend that. Or you can do $20 a month on the Pro plan, but you will be limited on the weekly usage. So keep that in mind. Personally, I use Claude Fable. Okay, so anyway, we're going to do a permutation test, and it's going to look something like this. So let's say you have a graph here, okay, and then this is your strategies P&L, okay, and it kind of goes up. What it's going to do is that it's going to run 1,000 simulations on random shuffled data. So while this is your real data, this is now your simulated data where like it looks like this, and then it looks like this. Maybe some of them beat your strategy like this, and it goes like this. Okay, so okay, let's say this one's your real strategy, okay, and then everything else is simulation. So it's going to simulate 1,000 times, okay. And then what's going to see is that when you look at the final here, when you look at the final profit factor, then your profit factor has to be able to beat 95% of simulations, okay? And then we calculate that in what's called p-value. Okay, the p-value, that result that Claude gives you or whatever AI you're using has to be below or equal to 0.05. Okay, what this means is that your strategy beat 95% of random simulations. Okay, the random simulations, the higher this number is, then the more random simulations actually beat your strategy. And what that means is that your strategy itself is likely random itself. It's likely due to noise. Okay. 0.05, this is the scientific standard that we use, which is really good. And later on, we're probably going to have to adjust our p-value expectations and threshold based off the actual strategy. But in general, a good guideline is 0.05. Okay. Okay, so that being said, this is where another like a bunch of strategies fail. So to have your strategy pass pass a good equity curve here, plus passing the permutation test, you're probably going to see around 90% of strategies fail at this stage. Okay, so that's really important. Again, don't be attached to strategies. If you have to throw your strategy into the bin, then this is most likely where it's going to happen. Now we're going to throw away another 90% later on, but you'll see how that is. Okay, so I'm going to make a new document or a new drawing board here. Okay, so that was step one. Okay, step two here. After we pass that, we're going to do a data split, and then we're going to do optimization. So I guess I'll put this into a bigger category. Optimization. Okay, so optimization is going to be the second step here. I think I would split into 4 steps. And this step is probably where you're going to spend the most amount of time. At least this is where most amount of time on one single strategy. You might spend more time screening a bunch of strategies. If you get unlucky and you just don't really find anything, that's good. But here in general, you'll probably spend a good amount of time as well. Okay, so first of all, let's say we have our data here. Okay. And let's say this is 16 years of data. Okay, you probably don't have to use 16. If you want to find something that's a bit more explosive, that is more regime specific, you could use something like, for example, 6 years of data, 5 years of data, or something from 2018 or from 2020, something along those lines. In general, I'm just going to use 16 for this example. I developed a lot of my strategies in the entire 16 years of historical data. There are dangers to that, but that's kind of a little bit too detailed for a video like this. But anyway, we're going to split our data into 3 different sections. So here and here, for this is going to be about 60%, okay? This is going to be about 20%, and this is going to be about 20. Okay. You can adjust these numbers as you see fit, but this is a pretty good guideline. Sometimes I like to expand this middle one a bit. So this first part is called the in sample. I'm going to abbreviate to IS. This one is called the validation, which I'm going to abbreviate as VAL. And this last one is going to be called the out of sample, which I'll call OSS, okay? Out of sample. So this data split is incredibly key. Okay, if someone has developed a strategy, a trading strategy, and they did not do this split, then their strategy is automatically invalid. Okay, it's just automatically a bad strategy if you haven't done this split. The reason is because this out of sample is incredibly important, because we're going to use it to test our sample, to test if it's overfit or not. If it's overfit, then it'll show up here likely in the out of sample, especially when we do our Monte Carlo permutation test on the out of sample, but that's going to come later. Okay. So each of these serve sort of a different purpose. The in sample here is where we're going to pick out a lot of our features. So let's say step 2A or something. The first one, I'm not going to write it out, but it's called feature engineering. So we'll call it FE. Feature engineering you're going to be doing on the in sample. So after we do our split, we're going to now look at the in sample. Okay. The in sample, what we're going to do now is that we want to start optimizing, and we want to start creating features that we use for our strategy. Okay, features in this case could be a lot of different things. And in general, you probably think that indicators, for example, is a good the same as features, but indicators is actually just one type of feature. Like a feature could also be conditional structures. So it could be something like time of day or day of the week or something like that. Those are conditional structures. Features would be or indicators would be something like, for example, the 21 EMA or RSI or MACD or something like that. Okay, so those are all included in what we call features in this. Okay, so we want to do we want to now screen for a bunch of features. Okay, so for example, let's say, and you have to kind of think about this depending on what your strategy is. Okay, so let me give one example. Let's say you have a strategy that's a cup and handle strategy. Okay, so you look for a cup, and then you look for a small handle, and then you're looking for a continuation of some sort, going up or going down depending on the cup direction. Okay, a feature could be something like, oh, the size of the ratio of the handle to cup size. It could be something like the cup height. It could be something like the cup width. It could be the handle width or something like that. So a lot of the features that you think about, in my opinion, is more effective if you look at specifically what your strategy is about and you develop strategies for that. I have a strategy that is a trend line breakout, right? So if there's a trend line and then let's say the price respected this trend line and then it breaks out, then I'm expecting it to go up. Okay, so something like this could be something like maybe the slope of the line. Okay, whether the slope is down or if it's going up, for example, that could also be a feature as well. So things like that, think about, and a lot of it you could actually develop or you could actually use just by looking at the strategy itself when it's actually playing out. Like if you just see it in real time, open up the charts, and then you just go look at it and go, oh, this could possibly be a feature. If you have an idea, just put it down in your list. In general, for me, I try to think and come up with about 20 features. Okay. 20 features is a good amount. If you can't think of more than that, then that's fine. You can also put some general ones in there as well, like such as the EMA, 50 EMA, 21 EMA, and the VWAP and whatnot. You can put those in as well if you want to. You could also go more nuanced in those. Like for example, I have a strategy that looks at like VWAP slope or the EMA slope, like specifically the slope of it, which can be useful as well. That can help you define trends or things like that. Okay, so think of about 20 of these features, okay? But don't force yourself up to 20. And we want to do general overall screening in the in sample only, okay? Only in the in sample, okay? No, don't touch your validation yet. Don't touch your out of sample yet, okay? And then after that, what you'll get is tell Claude to create graphs that look something like this, where like, the y-axis here is the profit factor. This one's, of course, this one would be, this depends on your feature x-axis. So it could be like, for example, I'm just going to give a random example. Let's say the RSI threshold. Okay. So it would be like, for example, let's say it only takes a trade when the RSI is above 20. Or something like that. So this is an RSI threshold, okay, which means it only takes a trade above 20. If it's below 20, it doesn't. But if it's above 30, it takes a trade if it's above 30, otherwise it doesn't, okay? And then you'll have like sort of here, which will be your baseline, okay? That means that without any sort of filtering, how does your strategy already perform? Okay. In the in sample, okay? And then you'll have something, maybe a graph, or it could be a bar graph that looks kind of like this, maybe something like that. Okay. It could look like that, or it could look like, I don't know, it could look like a slope up or something. Or it could be like a hill that goes up and then it goes down, or it could be something like this, sharp up, sharp down. Okay, so there's a different types of grass. Okay. Now let me and what you're gonna do is that you're gonna create 20 of these. Okay, there's gonna be 20 of them, and Claude can put it all together, so you won't have to worry about doing it yourself. They can put together the code and the visuals. Okay, but in general, you're gonna have a bunch of these. Okay, that is one for each of the 20 features that you're doing. And then you want to evaluate now. You want to pick your features based off of what you are like a couple of rules basically, because we want to avoid overfitting. Okay, overfitting doesn't just mean we're doing the sample split. A lot of it happens in the feature engineering side of things as well. So for example, the biggest thing that most people talk about is called feature sensitivity. Okay, I'm not going to write that out because it's pretty long. But you want to look at, you want to select features that one, like for example, okay, let's say this is like 20 threshold. Here is like 30, and here's like 10. You probably don't want to select 10 because it's performing worse than your baseline. You don't want to select 30 because it's performing worse than your baseline. In this case, you'd be like, oh, I want to select 20, right? So the other thing to think about, as I said just now before I interrupted myself, is feature sensitivity. Okay, if your feature is like this, and then it has a sharp increase up in a specific value here, and then a sharp decreases back down or anything like that, oops, then you don't want to select this feature. This feature is no good. The reason is because if you just change your feature a little bit, such as in this case, the RSI threshold, even just a little bit, and then it drastically changes your profit factor here, then it's bad, because what it means is that it's incredibly specific that you have to select that feature in order for your strategy to work. And that means that you are probably overfitting your model. Okay. So do not select things that have a sharp increase, sharp decrease, or in general, if it changes even just a little bit, let's say to 21 to 19, then this changes, then the profit factor changes a lot. You don't want a feature like this. Okay. If you have a feature that looks, kind of like this, like a slope like this, and you select this middle one, perfect. This is good. Okay. Okay, so or if you have, for example, like a strategy that is kind of staggering a bit, and then it kind of goes up here, you can select something here. But notice that, but also you have to keep in mind like the trade count. Like if you do the RSI threshold, obviously the higher you go here, then the less trades you're going to take. Okay, so think about if that trade-off is actually worth it. Like let's say if I select a feature that is here, and then we are losing like 90% of our trades, then that's no good. Like you probably don't want to do something like that because you don't want a trade count that is just too low. If you develop a strategy that takes one trade every month, then that's probably not super ideal. Okay, especially if you're doing it for prop firms, and like that's, you're just not going to pass evals with that. And in addition to that, if your trade count is too low, you're just not going to have enough statistical significance in the way that you can confirm it with more confidence. Like it could pass your permutation test by luck if you have a trade count that is too low, for example. That can happen very easily. Or it could just be profitable because the trade count is just too low. It hasn't had enough time to run, for example. So that's in general not good. Don't select things that reduce your trade count by too much, but that also depends on how much trade count you had in the beginning when we were doing our screening phase here. So if you're screening phase and you have a lot of trade count, you can afford to lose more trades here. But if it doesn't, then you probably have to be more stingy as to which features you are selecting, because some of them might be reducing your trade count by a lot. Okay. So there's other things to consider other than feature sensitivity here, like I said, but I'm not going to go over them in this video because this I did not expect to go into this much detail, in all honesty. But I'm going to start speeding up a little bit. So if you have any questions, again, message me in the Discord. Okay. So after you select your features, and the amount you select, it also depends. So let's say we select around 3 to 5 features. Okay. For me, I generally aim towards the lower side, maybe like 3 features, because if you do 5 features, not only are you filtering out more trades, But at the same time, you are potentially overfitting more the more features you select. So just kind of be aware that, if you select more features, you are running into that risk. But in general, this is not as important as the feature sensitivity part, in my opinion. So do as you wish. So yeah, let's say we select 3 features. Now we're finally going into the validation. Okay, we're finally in the validation phase now. But keep in mind that in the in sample, we are not selecting values here. Okay, so let's say we selected the 20 or RSI or something. You're not actually selecting that. The only thing we're selecting in the in sample is the features. Okay, we're going to select the actual threshold values in the validation. So that's kind of the purpose of that. Okay, so let me see if I can go a bit down here. Okay, so in the validation, what we're going to do is we're going to do this step. Okay, so I guess this is step 2. We're going to do what's called a walk forward fold. This F is fold, not the forward. Walk forward fold optimization, abbreviated WFO here. And this is where things get a little bit more complex, but again, you can just tell Claude to kind of do this. So it's fine. You don't have to do the coding yourself. Okay, so let's say this is the entire validation. Okay, this is just the validation, not the entire data set. Okay, we have the validation here. And what you want to do is that you want to optimize your values, as in you select the values, and then you want to test it on a segment, and then you want to walk that forward a segment. So let's say we have here, and then we have here. Okay, so what this means is that we're selecting data that's here and that's here. Okay, we're splitting up our data again. Okay, this here is going to be now our walk forward fold in sample, and this is going to be our walk forward fold out of sample. Okay. You could probably do like it depends. You can do a split however you want. Some people do like a year in the in sample, 5 months in out of sample or something like that. Okay, you can do however you want, but in general, maybe like a 60%, 70% split or something like that is pretty good. So you do this, you train on the in sample, and then you test on the out of sample, and then you record it down. Okay, record it down somewhere. I mean, Claude would be able to do that for you, but it'll record it down. You train on the in sample, you test on the out of sample. Then when you're done, you walk forward a fold, and this is now your in sample, and this is your out of sample. Then you do it again. You train on the in sample, you test on the out of sample. Then you walk forward again. Okay. Train on the in sample, walk forward, or test on the out of sample, and then you finish walking forward till the end. Okay. When you get to the end of your validation. Okay. In terms of how many folds you should do, you should probably do around 5 at least, is my opinion. But 4 is probably enough. This is just for demonstration purposes. Okay. So you want to do this, and you want to, you just want to do this in a fold sort of manner. This is just a way for you to basically like make it so that the threshold value that you select ultimately is not overfit, because what we're doing is that we're training on multiple folds. Okay, so the logic is that, oh, what are the chances that if I train on the next fold and this is our true out of sample, okay, what are the chances that if it succeeded on all of these folds that it's going to fail on the next fold? The chances are pretty low, right? So that's kind of the idea. Okay, so again, make sure you're not peeking into the out of sample every time you do each of the folds, but just tell Claude to do the walk forward fold optimization. It'll generally know what to do. Okay, so do this walk forward fold on your features. Okay, so like for example, if you selected RSI, you're now selecting RSI threshold. If you're doing like slope of the EMA, you're selecting the slope of the EMA here. Okay, the actual physical number. Okay, these are the ones that you're selecting here. Okay, if you have any questions on this, just feel free to let me know. Some people do cross validations and stuff like that. I personally think the walk forward fold optimization is one of the best. So this is the one that I always stick to. Okay. This also depends on how many features you select. Like, let's say you've tested a bunch and you only selected one feature and you're happy with one feature, you want to proceed. You might not need to do the walk forward optimization. You might just want to test it on the entire thing and select the best value from the validation. But admit that if you do it that way, you're probably going to run into higher chances of overfitting. But if your strategy is simple enough, you probably don't really need to think about that too much, because a simpler strategy actually means that you have a less chance of overfitting. Okay. So that is step 2. Oh, I put 2. This is actually 2B. Okay, 2B. Okay, now your last one. Oh, actually, this is the end of the optimization phase. So let's start a new document here. Okay, your last one. Step 3, after you finish picking out your values, you're going to do an out of sample test. And we'll call this true out of sample because we use the word out of sample here. But basically, remember earlier when I said to do your split between your in sample, your validation, and your out of sample. So we're done with this. We're done with the data to the left now. And now we're focusing on the out of sample. So this is going to be the out of sample test. However much data you have for the out of sample, all you have to do now is with your selected new features and your values, your threshold values, put it into the out of sample test. Put it into the out of sample data and run the test, okay? Now, you're looking for a couple of things here. You're looking for the profit factor. Okay, the profit factor, in general, the out of sample is not going to perform as well as the in sample, okay? So tamper your expectations. It's just generally going to perform worse. If your out of sample is performing better than your in sample, I would consider that a little bit suspicious, and it probably is due to luck. So as a result, I wouldn't be able to have that much confidence in the data itself. But your profit factor is probably going to be worse than your in sample, but it still needs to be good, okay? This depends on your expectations, okay? Some people, if they have a profit factor of above 1.05, they're satisfied if you have a high Sharpe ratio, okay? So you have to look at all these factors together. In general, I'm not satisfied with that. Maybe something above, something above 1.1 or 1.12 or something like that. Maybe I'd be satisfied with that. But of course, it depends on how it compares to what we're going to look later. So the profit factor, this is not everything. In fact, this is hardly a factor in what we need to consider. The thing that I mentioned just now that's more important, in my opinion, is the Sharpe ratio. In general, I want something above 1.0, but 1.0 itself is generally not that good. Okay, in comparison, the market itself, I believe, if I remember correctly, is about 0.78 or something like that. This is SPY by itself, okay? So you want to at least be above SPY, because otherwise you're kind of doing this for nothing. Okay, 1.0 here I say is the base minimum. Okay, I personally don't really like it that much. If you want to do something like 0.9 or something and you like your strategy, go for it. Maybe you could get something good out of it. I have some strategies that forward test that are about 0.9-ish. That's because I like it for other reasons. I'm personally just testing it just to see how it goes, but I would probably not run a strategy like that. Okay. In general, what I'm usually satisfied with is something with a Sharpe ratio maybe about above 1.3, maybe 1.4. Okay. If you have something that is above 1.6, this is incredibly good. Okay. Incredibly good if you have something above 1.6. Some people have really high expectations and they have a Sharpe ratio above 1.6. That's their base minimum. Some people have high expectations like that. For beginners, I would say don't expect anything like this. And if you don't spend a lot of time developing strategies, you're probably not going to come across a strategy that's above 1.6. 1.3, 1.4, that's fine. If you have something above 2.0, super good as well. I would get a little bit suspicious if it got to this stage, but in general, these are probably the threshold values I want to look at. Okay, so I'll say the Sharpe ratio is the next most important thing. And oh, actually, by extension of this, you also should look at max drawdown. Okay, so max drawdown, something you look at, but that's basically kind of the same as Sharpe ratio. You can replace the Sharpe ratio with something else. If you want to replace it with the Sortino ratio, the Kalmer ratio, or the Martin ratio, that's perfectly fine as well if you want to do those. I personally like to use the Sharpe ratio as sort of my baseline, and it's also the most popular. Okay, the third thing you want to look at now is another Monte Carlo permutation test. Okay, so we discussed what the permutation test in the very beginning here. Wait, here. Okay, so earlier we did it to screen our strategies. This time we want to do it only on the out of sample, okay? We're not going to do it on the in sample in this part. Well, you did on the in sample before, but we don't care about that plus the validation. We want to do it on the out of sample, and this is with all the filters that you put as your for your features, okay? Your out of sample. Um, so now what you want to see at this point is a p-value, and you can still do 0.05 if you want. But this also kind of depends, sort of. Like, for example, if earlier I selected a feature that did not pass the sensitivity test, I might want a stricter p-value, something like 0.01. Ideally, you probably want something that is just less than that is just 0. Sorry, not less than 0. That is just equal to 0 or something. This is the most optimal, obviously, and you'll come across a lot of strategies that will be 0 here. But in general, maybe 0.01, 0.05 if you want to just start off with. The reason I'm okay with 0.05 with a lot of my strategies is because I'm going to be doing just a for test on them. Now, once you get more experienced, you probably don't really need to do the for testing anymore because they're true out of sample. If you truly did pass this honestly, and you did it correctly, then you probably don't really need to do a for test, especially if you've already tested your live connections with other strategies. Okay. So, so once it passes this, you're generally doing pretty well, okay? I'm looking for a graph that looks relatively smooth, that's consistently making profits, or it could be something like, with a really long tail and then it kind of goes up from there. Something like this, okay? But look at these factors combined and think about if you want to do the for test. Okay, now let's talk about really briefly how many strategies are going to get to this stage, okay? Step 2, in this optimization, and you do the walk forward fold optimization, you're gonna lose probably another 80% of your strategies, okay? I said, yeah, so you're gonna lose 80% more of your strategies at this stage. In the feature selection, that includes that's the whole entire optimization phase. So that includes the feature engineering stage, and it also includes the walk forward optimization. You're going to lose another 80% of strategies, and that's because you're just not going to pass this test. When you do the in sample, out of sample, in sample, out of sample, you're going to realize that each one of these folds is not going to perform super well in the out of sample. And then as a result, you're going to be like, this strategy it ends up kind of sucking. So then you just don't want to proceed with it, basically. Okay, so you're probably going to lose another 80%, maybe even 90% of strategies here. And that's on top of the 90% you're already losing on step 1 on your screening here. Okay. Don't be discouraged. Don't be attached to your strategies. And another thing I will note, if you don't don't really redo your strategies. Like, for example, let's say I selected a bunch of features here and I did the walk forward fold optimization and then it fails. And then you're like, oh man, that sucks, but I think this still kind of has promise. And then you go back and you do the feature engineering again. You select different features and then you come here. That in general, I just wouldn't recommend. Just don't do stuff like that, because the more you go back and you redo, the more you're turning everything into an in sample, and you're overfitting your strategy. Do the walk forward fold optimization, and you should have selected the proper features the first time. If it fails, move on and go back to the screening phase and go back and rescreen for more strategies, okay? Same with the out of sample, okay? The true out of sample. Touch this only one time only, okay? Do not touch this more than once. If you pass the walk forward fold optimization here, and then you're like, I can finally test on the out of sample, and then you come here and then it fails, or if it's not to your expectations, let's say the Sharpe ratio is like 0.8 or something, and you're like, oh, it's so close, can I just go back and adjust a little bit of my features to like make it a little bit better? No, don't do that. You're overfitting, okay? If you look at the out of sample more than once, okay, then you are in general overfitting, okay? Now, if you want to look at it just twice, and you're like, oh, I'll just make one adjustment, then you're probably going to have to do a longer phase of the forward testing. Okay, so it's up to you if you want to make that sacrifice or not. In general, I only look at this once. Okay, if you look at this more than once, you are going to be overfitting, because your out of sample will then turn into your in sample. Okay, got it? The purpose of the out of sample is that it is never seen before data. Okay. Understood? Okay, now that we got that out of the way, let's move on to step 4. Okay, step 4, for testing. Okay, so now that we're here, this basically just means run your strategy live, and that is guaranteed to be never seen before data, and see how it performs. This is also where you test things like slippage. By the way, don't forget to put fees and slippage in your strategy on the screening phase in step 1, but it's a good way for you to test slippage, speed of execution, reliability of your data feed, and things like that. Okay, so you want to test this on a paper account. Okay, and in general, you want to test it. Okay, there's different people have different standards. Okay, some people say test it for about 2 months. Personally, I don't think amount of time is really a good measurement, because in general, some strategies trade more often and some strategies trade less often, right? So 2 months is what some people say. Some people say 30 trades. But the thing is that, like if you look at a strategy, okay, and then let's say this is 16 years, and then you have a strategy, let's say it goes up and stuff, and then this was when you finished your back testing, step 1 to 3. Okay, you did your sample split, everything, and then this is where your forward testing begins. If you trade for only 2 months or 30 trades, you'll probably make like a little dent here, okay? And let's be honest, in the grand scheme of things, this is not really a lot of data. Okay, but it also depends on what your Sharpe ratio is. That's why I said, the Sharpe ratio here is incredibly important on your out of sample. Okay, because let's say you have a strategy that is less smooth. Okay. Oh, that's a terrible graph. Okay, let's say you have something that's less smooth. Let's say it goes up and then down and then up and then down, up and then down. Let's say it's kind of like this, and this is where you begin your forward testing. And let's say you only trade for 2 months or 30 trades. And then let's say your trading has just gone down like this, okay? Because this is so little data in the grand scheme of 16 years, how can you interpret this? Is this overfit because your strategy is overfit, or is it a natural drawdown because you've seen slopes like this before that goes down? It's very difficult to tell if you don't have a lot of forward testing data and if your Sharpe is not as good. If you have a higher Sharpe ratio, like this one would have a higher Sharpe ratio, then if you, for example, if this strategy goes down immediately, like this, then you'd be like, oh shit, this is a little bit more than drawdown I've seen previously. It is probably overfit. But if you have a Sharpe ratio that's not as good and it has larger drawdowns in the past, it's very difficult to interpret this as if it's overfit or if it's because it's natural drawdown. You see what I mean? And that also depends on how long you forward test this for. If you're only doing 2 months, you're probably going to make a little bit of dent in 16 years of data. Now, if you have only 5 years of data, for example, that's a different story. But in general, it's going to be a pretty small portion of your overall data that you look at. So as a result, it can be very difficult. So for me, that I've tested for 16 years, I've tested a couple strategies for like 4 months now or something like that. The ones that I hooked up to the Discord, like Wagyu Teriyaki, probably has about 4 or 5 months of data now, which is pretty good. And even then, I'm just like, oh, it's just not good enough, because when I look at the overall things, the overall data, it just doesn't look like, I just can't draw a conclusion one way or another. Same in the positive side, right? Like if you have some data and then let's say you have, this is when it begins for testing, and then it like shoots up, I'd be kind of suspicious. Like this is probably due to luck, okay? It could probably be due to luck because it never performed that well in the past. Well, maybe it did here because my drawing sucks, but never performed that well in the past. It's probably due to luck. So as a result, that's probably still not enough data for me to look at to make a conclusion on whether or not this strategy has a real edge or not. Okay. So you got to think about these things as you're forward testing and kind of analyze them and keep track of them as you go. Okay, there's a book that I read. And you know what he said? He was like, okay, I developed a strategy. Put it in forward testing. And then I walk away for 6 months and then I come back Evaluate, not enough data for me. I walk away for another 6 months and I come back and I look at it. Now, that guy obviously is incredibly diligent in his strategy, okay? But for our purposes, we probably don't have to evaluate every 6 months. Maybe every like 2 months or something, come back and take a look at it and reevaluate or something like that. Um, so yeah, ideally you probably want years of data, to be honest, for me to be confident. But in reality, when you're actually running this live, you probably don't have the patience to run it for a year or 2 years or 3 years, right? So you should develop multiple strategies. Like for example, I probably have 40 plus strategies now that I'm forward testing, which is probably more than most people would be doing. So you don't have to make that many strategies. That took a long time to do, by the way, because each of these strategies are pretty difficult to make. Okay, if after all the forward testing, you even come up with one strategy per year, then that's already pretty lucky. Okay, you're already pretty good, like on the right track. But that's okay, because in reality, when you're developing strategies, you only really need one or two strategies to be profitable, to be set for life, basically. Like for example, if I have a strategy that looks like this and that is performing well, and then I've confirmed it performs well because I've had enough forward testing data and things like that, then I could just set this and I can always be beating the S&P 500 every single year. I just put my money into this, and then there's a whole different mentality for scaling up on how you should size up on your accounts. I'll go over that on a different video or tutorial perhaps. But you're basically set. Like you just run this one strategy and then you just don't have to look at it anymore. It just runs with you for for however long that you need to. Of course, you'll have to come back and monitor it every so often. Now let's say you passed all of this and you got a strategy and you got enough forward testing data that you're pretty confident that you're okay with running on a personal live account or on a prop firm account. Then at this point, you want to have multiple strategies for a composite portfolio. So let's say you develop a strategy that is a momentum continuation. Then you have another strategy that's a mean reversion. And then after that, you have like, let's say one that trades Asia session overnight that captures the overnight market drift or something like that. Then you want to combine those strategies into one portfolio, because if you do, you generally will see the biggest thing improve, which is the Sharpe ratio. So in general, like let's say you have a strategy that normally looks like this, another strategy that kind of also looks like this, it chops, and another strategy that looks like this. When you combine them, they're in general going to be smoother, okay? So combining strategies together is very good, okay? Especially if you combine multiple strategies that trade different styles. That's why I said, like, for example, you have a momentum continuation and you also have a mean reversion. You have one that, trades during Asia session, one that trades during New York. If you have some strategies that differ like that and do not have correlated trades, and you can measure that with some other statistics and stuff, then in general, that's going to be pretty good to put into a composite portfolio. Okay, so that's in general what you want to do. So that's why when I run my portfolios, I have a bunch of strategies that I see that looks pretty promising, and then I put it together. I select the ones that have low correlation and are performing well, and I put it together into my accounts that I'm trading with. Okay, so you want to eventually get to the stage. In general, if you have two or more strategies combined together, that's pretty good. Two is good enough. You can run two strategies together. Ideally, you probably want to run more than three, but that's fine. Like two is fine. You're always developing more strategies anyway, so you can always mix and match later as you come in, as you have more promising strategies. Okay, so in general, that's pretty good. Now, the final part of this video I want to talk about is going to be expectations. Okay, so a lot of people, for example, ask, "Oh, are you beating the S&P 500 with your strategies?" Which, in my opinion, is incredibly silly when you're asking algo traders or even manual discretionary traders, like how you're beating, if you're beating the S&P 500. It's just kind of a like bad question, because you're almost always going to be beating the S&P 500 if you develop a strategy that works. Okay. The reason is because of this Sharpe ratio. Okay, the better Sharpe ratio you have, the better you can beat the S&P 500. Okay, for example, let's say I put $2,000 into an account. Okay, and I'm trading just one micro. I'm like, or sorry, not yeah, 2000. Let's say I'm trading, and then the max drawdown the strategy ever has is like, let's say like $500. Okay, $500 max drawdown in a single session that I've seen it perform in the back testing and the forward testing. Okay, at a time before it recovers its original amount. In that case, did I really need this $2,000? Like I could have sized up 2x and my max drawdown would have been 1,000. In which case the same account size would have been the same, right? Let's say I run the strategy with with single contract $500. In this case, let's say I beat or let's say I increased my portfolio by like, I don't know, I'm just gonna give some random number, like let's say 5%. Okay, 5% in general doesn't beat the S&P 500, right? But when you double sized it to 1,000, now you're at 10%. And because you're at 10% now, let's say I size it up again to 1,500 and you're at 15%. Now you're beating the S&P 500, right? Because your initial account size didn't change. All you did was size up. And the reason you're able to size up is because you have a high Sharpe ratio. Like if I had $2,000 account size, and then let's say the max drawdown was like 1,300 or something like that, then I can't really 2x my account, because if I did that, then I would have been ruined. Like my account would have been blown, right? We actually measure this in what we called a risk of ruin. And you can do this in like a Monte Carlo, but basically you can shuffle all the trades and you can calculate with this account size, what are the chances of my account blowing up? Anything that's less than single digits is pretty good. So anything less than 10%. But if you have higher expectations, anything less than like 5% is what I would personally go with. You can also increase your account size to accommodate for the risk of ruin. So that's totally up to you on how much capital you have. This is if you're running on personal live account, by the way. But if you're running on prop firm, that's a whole different story because you're going to be calculating your rate of passing and getting payout, right? But in general, the reason why I think the question, are you beating the S&P 500 is stupid, is because ideally you're going to develop a strategy that has Sharpe ratio, and you're going to be you're going to be able to scale up a lot that you're almost always going to be beating the S&P 500. It's just kind of silly to ask that question, in my opinion. Okay, so now let's talk about expectations. Okay, if you're a beginner, I suggest aiming for beating the S&P 500 by 50 not by 50%, making 50% of your portfolio in a year. Okay, what's the S&P 500 average? It's like anywhere between 8 to like 12%, right? Okay, so you're already beating the S&P 500 way more. Okay, aim for 50%. Okay. The authors of the books that I've read, and of course I can't say this to my own strategy because I haven't run them for necessarily long enough and I have a lot of strategies to evaluate. I would say the author has strategies that are giving him 150% returns. Okay. So once you get good at it, I would say start aiming for the 150% returns on your portfolio. Otherwise, in the beginning, stick to a really easy goal, like 50%, for example. But don't make it too unrealistic. If you think you can't beat 50%, which personally I think anyone can, as long as they are disciplined enough and you sit down and you actually develop the strategies in a proper way, 50% is a pretty good target and is relatively easy to beat, in my opinion. Okay. Like, for example, like I already like I'm running one of my strategies on a personal live account, and I was just testing it in this case. So I started with $2,000, okay, and right now the account value is about $2,600 ish, and that took like a month or something. So like in a month, I'm already above 25%. I'm already close. I'm already like close to like 30%. So so like think about how like it's not that difficult to beat. Of course, I have to keep running it, so I can't say anything for sure. But in general, 50%, you know, probably a good baseline goal to look forward to. Okay, so the last thing I want to say, and I should have said this in the beginning, this is of course not financial, not financial advice. I have to say that, and I'm personally by no means like a super like expert or anything. There are plenty of YouTubers out there that teach content and plenty of books to read, and I am by no means like an expert compared to these people. Okay, I've only sort of been doing, how long have I been doing this? Like over a year or something, a year or something. I've only been doing this myself, and I've developed strategies, and I've experienced all the failures that I mentioned before, creating overfit strategies, future leaking, and things like that. And I've learned quite a bit since then. And I've only like, the learning process took me a long time to sort of get here. So a lot of my strategies, I've had to throw away tons of strategies, and the ones that I'm left with, the ones I'm for testing, I said I for testing 40 of them. Maybe like maybe I don't know, 7 or 8 of them are even worth looking at. For example, up until this stage of the for testing. So, as much as I know, I'm still personally learning myself. So, if you're an expert and you're watching this, feel free to give me criticisms as well. If you're a beginner and you want to ask for more questions on how to develop algorithms, then feel free to message me. Of course, like I said, this is only one of two of the methods of developing strategies. This is for simple rule based strategies. And this is what I personally do for my strategies that I developed that are simple rule based. If you want to do mathematical models and things like that, that's a whole separate topic, and we can get to that another time if you guys are interested. Okay, so that's pretty much it. Again, this is specifically made for the Delta Hive community. So if you enjoy this content, please let me know. And if you join the Delta Hive Discord, you can find my strategies there because I send alerts of a couple of my strategies into that channel. So if you want to follow them manually, for example, you can. I personally have them automatically connected. And if you want to ask me about my strategies or anything like that, feel free to. I'm always happy to answer questions. Feel free to send me a DM, or what I prefer is that in the Algo discussion channel inside the Discord, send me a message there, just at me and stuff. We have a couple of other Algo developers. I developed a lot of my strategies in collaboration with Big Pigeon and also for Hago, which some of their strategies are featured on the Discord as well. Collaborating with someone else could also help in your motivation as well. So yeah, anyway, let me know. I hope you enjoyed this video, and I will see you in the next one.